Benjamin once said the nature of management investing is about risk management, not yield management. One can learn all pricing formulas, master all technical analysis method, belonging to each variable in the balance sheet math, but still fail in investing. Why? That question is not just a start. The beginning of a book that is a journey, lifelong questioning of the government me. Because investing, as Ben Graham once said, it is not the art of making money but science of error control. So what are you looking for every time you open the board? Price? You want to win the market school or want to understand yourself better through every financial decision? This must be a book for people who want to get rich quick. This is the map for people who want to go long without hitting disoriented by light from the market. The school suddenly went out. And as always, I encourage listeners to buy and read to fully appreciate the content. This book. Because only when you read it, by the end of the book, you will understand the nature of the problem you are hearing me tell. And now let me start by summarizing the book. I used to walk on the avenue back then. In the early morning when the lights first started to light up the dream of millions of people, the sound of shoes clicking on the damp sidewalk, and in my head a simple but painful question rang out. Rock, what is the real difference between investment and speculation? If only for one neck coupons increase we call it investment, then any gamble can wear the coat intellectual shirt, but if because believe that it has value, we hold it through the storm season, through the red-hot sessions, is it true? Real investment? In the chats talking to young investors, I often tells the story of two people. Men buy shares in the same company on the same day, one person. Based on financial statements, intrinsic valuation, revenue prospects, holding in many years, the remaining people bought because they heard the news. Interior, expect prices to increase rapidly in the next few weeks to sell. Stocks can be but the behavior is completely different. Invest or speculation lies in the mind, not in the name call. Investing in the most basic sense is act based on careful analysis, expected capital safety and satisfactory returns worth. It doesn't promise excitement, it requires patience like sowing a seed sow in winter, wait for it to sprout in the spring breeze. Speculation, contrary to the same, like lightning, thrilling, attractive. But are you fast enough to avoid getting burned? On fire? If you look at the stock price increase as a personal achievement, you are playing a gamble in which the market is the dealer coin. But if you put your faith in real value, regardless of the current stock price, how you dance is how you truly are a person. Smart investor. But sadly instead, that distinction is increasingly blurred. The buyers and sellers quickly called me as a long-term investor. The surfer's wave named the portfolio as value fund. There is no shortage of predators in today's market. Act like a scholar but act like a child. Silver. I have met people who are proud of one big in the stock market boom 19,680–1969. They told of dizzying profits. Like telling about legendary matches. But then the market turned around. Genius investors become loss bearer, and I understand people. Truly intelligent people are those who do not let themselves be fooled. Fall control the purse, you may ask, so a smart investor should expect hope for what? I'll say it straight, no, must be a profit that exceeds every year, stability through fluctuations in a birth rate, reasonable profit, enough to beat inflation, enough to build assets, but don't bet future into crazy gambles. The market is a fickle creature. Today it praises you as a god, tomorrow it will crush you like a sinner. Do not let its emotions dictate its mood, friend. Don't let the market beat you, distract the inner law. Invest not a game, not even as a competition of who is smarter. That is journey of training yourself to see what others do not see, to keep be rational when the crowd is panicking, and most importantly for long-term survival. If you expect the market to always be rational, you will be disappointed, but if you learn how to profit from temporary absurdity in its time, you will be the survivor. Remember, the speculator lives on hope, investors live by knowledge. Invest intelligence is not about choosing the right stock. The trick is in choosing the right one. Principles of life, the rest is just the evolution of time over the years, months of teaching and investment. I realize that most failures come not from lack of knowledge, from false expectations. People enter the market like steps. Go to the casino, hoping to win big, hoping to change life, but the market doesn't pay for dreams, it only rewards those who understand the profound nature of perseverance. There is one thing that few people accept. Accepting high profits always comes with big risk, and if you think you can consistently above average returns without taking risks, you are fooling yourself. Me. The market may throw you some initial victories as a lure, you go deeper, but then it will be reclaimed, usually all. Plus self-esteem important. I have seen many new investors start with strong belief in market sense. They don't need a board balance sheet, no need for cash flow due, just a hunch. When stocks go up, they feel validated. When stocks decrease, they blame external factors. But they not understanding that confidence is not built on the basis of knowledge is a knife, double-edged. Smart investors need learn to work with uncertainty. Sure, it is not pessimism but sobriety, not always available. The correct answer is always a correct procedure, and the process begins from analysis rather than prediction. Guess. Once a student asked me to do, how do you know if you are investing speculative? I answer with a question other. If the stock you just bought drops 30%, what will you do tomorrow if the answer is for sale now? Maybe you are speculating. If you say so, does the intrinsic value change? Then congratulations, you are getting closer. The mindset of a smart investor. Take examples from market times. Crazy school like 1929 or closer to Bongbong. There they call everything free investment. Why is the price increasing? Businesses and profitable, no clear plan. Obviously, it is still highly valued just because the crowd believes in a bleak future. When bubble burst, the distinction between investors, the mechanism, and investors suddenly appeared clearly. Like a crack in glass. The appeal of speculation lies in the fact that it hits the fundamentals. The most powerful of human beings, greed, and head. On the contrary, it requires reason and discipline, qualities that few people practice. You must learn to refuse short-lived pleasures. Short-term in exchange for long-term results. Right, learn to stand still when the market roars and walk when everyone stands still. I'm not against speculation, as long as you know what you are doing. If you want to order a small portion of assets in speculation as a game, do. But never confuse it with investing, and never let the game part overshadow the property part. Imagine you are rowing a boat on a river. Speculation is like riding the wave, fast, exciting but unstable. Investing is like fighting climb with the flow, slow and tiring but controlled. Sometimes the waves will sweep you away quickly, more but only if you know you are climb, you will know where you are going. Smart investors therefore do not must be the fastest, best or richest best. They just need to be consistent, need to understand what is within control and what is beyond what is not. And the most important thing that I learned after decades in the market, the truth is you don't have to win everything at the time. You just have to not lose in those at the time of decision. The day I first faced with a question that most investors often avoid. How to defeat an invisible enemy, inflation. Not a roarer as thought. Recession is not a wave as big as the financial crisis, which is something that quietly erodes purchasing power, every dollar in your pocket every year, like the wind scraping on the rock. In the years in the mid-20th century, America witnessed something that many generations of investors had not done before. It has been said that money is not immutable. The dollar you hold today, if not properly profitable, will be just that, a shadow of itself after a few years. And that is a scary truth. I once told a young student that if he sent money in the bank at 2% interest while inflation is 3%, are you losing money? On paper, not deducted from account clause, but you are losing the ability life of that money. Young people often didn't see it until a drive. Bread prices doubled but income constant. There was a time when people believed that government bonds are safe, absolute. But after the 1940s, when inflation begins to creep into the economy, post-war economy, that confidence was shaken. Lay-term bonds that have been awarded considered a peaceful harbor, now become a low interest rate trap, who keeps it? That person is gradually being eroded by rising prices. Latter and then people turn to the neck votes. Many scholars, analysts and investors claim stocks are hedges best anti-inflation. They point to the long-term growth chart. They say if you invest in the stock market in 20 years, you will beat inflation. And it is true that numerically, that does make sense. Correct part, but I lived long enough to know between theory and practice is one gulf. But where human psychology often was the first victim. Those who holding blue chip stocks for a decade but still lose to inflation. Not for business weak industry because they bought when the price reflected too many expectations and then expectations that hope never comes. And inflation then do not wait. It moves forward as a disciplined robber. No reason needed, no warning needed. The question that I set for any intelligent investor: which do you have a specific strategy to deal with? Deal with inflation yet? Is not blind faith that the market will automatically adjustment is a system of thinking, an action frame where you allocate resources production not only for growth but also for security. During that time, I started first look at a particular asset class. Stocks of companies with the potential shift the cost burden to customers' goods. Businesses have the right to decide price, branded circuit, structured flexible costs. Those are the names exist through many economic cycles, not eroded by inflation. I also look at real estate, at commodities and gold, not to encourage accumulation gold storage as an investment religion, but to understand the role of tangible assets during a period when paper money lost its value. And I draw a simple but important conclusion. Full of weight inflation is not an accident disaster, it is part of the structure of the foundation modern economy and smart investors. I can't ignore it. An investor keep $100,000 in cash under the pillow all the time 20 years. When he opened it, he still saw the child. That number, but its purchasing power has halved. It was a silent failure. Quiet, no major events, no news, bad news, only time and silence of rising prices. I'm not saying that stocks are the only solution, but I believe that if chosen correctly, if buy at a reasonable price, stocks, especially shares of companies with advantages, sustainable competition, will be one of the least risky means of passing through inflation in the long run. But no, not all stocks are hedges. I have seen investors throw money at companies grow rapidly just because of trust that inflation will push up the price of everything, including stock price. They are confused between price and value. A familiar mistake, because inflation can push up costs faster than revenue and profit, that the only thing that should be valued is shrinkage. Again, a company that sells more can still be poor if profit margin eroded. Safety of capital, and in inflationary environment that safety is not lies in absolute risk avoidance, which is understand what risks are acceptable and what risks are not. Any risk of destruction of property. Keep cash too much is a risk of destruction. Buy stocks. Ignorance of the law is a risk of destruction. But investing with analysis in business really capable, that's the risk. Acceptable in an era where central banks always print more money than expansionary monetary policy near as a matter of course. Meaning inflation will not disappear. It will become a part of the core operation of every platform economy. So anyone entering the market schools without a strategy to protect purchasing power is like a tightrope walker. Don't look down. I once emphasized to a group of investors middle-aged advice that you can't just look at the nominal rate of return. You need to care about real profits, that is after deducting inflation. If a sum investment returns 5% per year but inflation, if the growth is 6%, then you are going backwards. Just go back silently. The pain of the devaluation did not come as a crash. It bleeds every day. And that is the truth. Dangers of inflation: it doesn't make you panic, it makes you are complacent. Then one day you realize the currency has weakened too much to get what you once took for granted. But perhaps what worries me the most is a collective delusion. When people started to believe that the market was always going up, that inflation is temporary, that the central bank will always be in control everything. That is when the biggest risk is silently forming. And investors know I have to be the one to recognize the signal early. Even though it goes against the grain of the crowd. If you ask me that is there any surefire formula? I will answer honestly. Do not have formula, only principles. The core principle is to preserve real value, not account balance, invest in what you understand, stay away from words promise of unknown origin and always save a portfolio for assets that have defensive in nature, even when they not attractively profitable in the short term. Because in times of inflation, it is important that you maintaining purchasing power is more important than achieved record profits. And sometimes that silent victory is exactly that what distinguishes an investor from an existential one. Be with the person who was swept away. Inflationary like a stream flowing upstream, you don't see it. But if you stand still you will drift. Only when you climb, you hold position and investors know I am a climber. Even though the water that still pretends to be peaceful. If you really want to understand the stock market, can't just look at today, you must reverse, must go against the current time, must listen to the murmur boom from the past, where the market not only is a chart that is a long play century, full of turmoil, emotions and lessons learned the hard way in the early 20th century, the market US stocks are still a world small, where stock prices move slowly spacious and investors can live for a lifetime but never heard of the Jones Index. Then World War I broke out. Then came the Great Depression of the year 1929 and since then the history of the American market has been into a curve. The peaks highs of joy and deeps of sorrow. But don't think of the market as a straight line. Random, logical, cyclical, and rules if you have the patience to read got it and the most important thing that the calendar history shows that what has happened will happen. Happen again, not exactly, but with same nature, greed, fear, jealousy disappointed and then start again. Look at the Dow Jones Index from 2005 to 2008. 1897 to 1971. Nearly 75 years of history, you will see one thing paradox although America is developing rapidly in all aspects, the market can still it took a decade to get back to the old peak. Wallet for example, after the 1929 crash it was not until 1954, it took Dow 125 years to recover to his former level. Old. Do you think you can wait? I'm not telling this to spread sadness. Important for you to understand. The market does not patience is always rewarded ring by steadily increasing the price. Have periods when stocks move sideways for 15 to 20 years. And if you step into the market school with the belief that whatever you buy is worth it, go up. You are entering into a marriage. With illusion. 1972, Pain Index hovering around 900 points. Someone called that is the sign of explosion. Someone said this is the beginning of a decade of growth strong. As for me, I turn back to the past. I look at past cycles and I wondering if we are an enemy or new at the foot of the mountain. A smart investor in my opinion, we should not just look at the index. Present but must put it into context history. 900 points in 1972 is not the same with 900 points in 1955. For money value different currencies, different interest rates, business context other industries and especially the level of assessment stock price in 1972 compared to real income is at a high level worrying. If you look at the price factor on average PE earnings of the market school, the figure in early 1972 fluctuated around 20. You will see the market is being priced expensively compared to history. And every time the market is expensive, the risk is always hang suspended, not fixed. The device will collapse, but the opportunity to achieve get high profits in the near future will be suffocated. I know people have tendency to believe that this time is different, that the past is obsolete, that we are living in a new era where technology, monetary policy, and globalization will keep the market going up. I'm not denying those changes, but I also do not forget that each era everything in history ends with the familiar crash. When people talk about stock market as a printing press, long-term money, they often forget that implied terms. You have to live long enough to witness that long-term and not be affected fall out of the game at the bends. Tricky remember, between 2 points A and B there are always valleys on the chart that courage is challenged and the peaks mountain where greed is tested by fire. For example, after the recovery from the 1932 bottom, the Dow Jones Index doubled within a year. A few years, then from 1937 fell again. The market just fluctuates, as if tantalizing those who believe in the path straight. I still remember clearly the year 1966 Dow Jones hits 1,000 and then turns around. For many years afterward, the cycle repeated itself. Up and down around 9,001,000 like trapped in an invisible box. Friend, imagine how investors feel. Spent money for 57 years but the property did not work move. But that is the reality, and that reality is not for the faint of heart. Patience, especially not for followers chasing the dream of getting rich quick. I used to advise to a young investor, don't invest because you think the market should go up. Let's start because you have reason to believe that the value you buy is cheaper than real value. The big question of early 1972 is the market too expensive? Are not? My answer is based on the calendar. History and data are highly likely. Proportion average PE of blue chip companies is at a level that makes me feel insecure. And interest rate. Direct competition factors with stocks on an uptrend. In such an environment, border security almost disappeared. People buy stocks coupons not because they are cheap but because they are not where else to hide. I lived through enough cycles to know when people buy for fear of missing out it is a sign of a bubble. Ball. Not a crazy bubble as in 1929, but it is a kind of hidden bubble where reason is gradually replaced by habit, and the worst habit in investing is think that stocks will always outperform bonds. I do not call for any price you withdraw all your money from the market, not predicting collapse, but I call please be awake, calling for a comparison against the tide of history, call for investors never lose your skepticism, because when you lose your doubt, you are no longer investors, you have become a person. Dream of wearing a suit. You walk into an apartment room full of paintings, each picture is a historical stage of the market. Some pictures are dark, some are bright. But if you just look at the closest picture and assume that it is the big picture, you are missing the majority. The truth is, the market is always repeats itself in other ways each other. Use history as a tool. Positioning is not about guessing what the market will do. What to do next week to understand the market. Where does the school stand in the big cycle? And from there you can choose to go slow, back, or go on. But with eyes open big and with an undisguised mind, you will don't hear me shout sell all or buy right. I just whisper one thing, learn from the past to avoid paying tuition fees future. When I was young, I thought that beating the market is a matter of the quick and calculating. But the more I pretend, the more I understand life. Survive the market safely and no loss is the true art. Real. And that's why I'm talking about investors. Defensive. Do you know? Not everyone needs to be an investor professional. Not everyone has to study financial reports, evaluate business model, or track each market fluctuations. Have people, and they are the majority. Just want to preserve your assets and generate profit, stable and not surprised by the blows, financial shock that is the investor defense. So what is a strategy? True defense. First, forget it. Go with the two-word profit promises number. Defensive investors are not looking for shocking returns, they seek the sustainable. If you expect 5%, 6% per year stable, don't lose sleep over the market. You are on the right track, and to achieve there is one rule: never change. Reasonable asset allocation between stocks, bonds and stocks for decades, years of market observation. I realize that no fixed ratio is perfect forever. There are times when stocks should 50%, maybe it should be 25% or 75% depending on market conditions, but if you need a safety rule, let's start head with 5050 formula, half neck coupon, half bond, and then adjust within 25-75 amplitude if needed, but absolutely not extreme. Why like so? Because bonds are the anchor that holds portfolio, not swept away by the emotional storm. Touch in stocks, if carefully selected, the kidney is the engine of long-term growth. The balance between them is like a combination. Combination of reason and instinct. Missing one in two, you will be lost. I have met people who put all their money in stocks because thinking that he was young and could afford to lose, but then the market crashed and the endurance disappeared faster than expected. Also have people who hold all their assets in bonds because of fear of risk and then losing the opportunity to accumulate when the market boomed. Neither must be defensive but is irrational in two ways opposite direction. There is one more thing that the house defensive investing needs to understand: safety not from avoiding risks but from risk control in a system. Logical system. What does that mean? You need to choose the right type of bond. Wallet high-quality government bonds and choose stocks of companies that have stable history, consistent dividends and governance transparent. No need to be flashy, just need steady. In a lecture, I once asked my students, if you had $100,000 law, what are you going to do with it? One person said, I will look for fast growth stocks most and invest all. Another person, I'll deposit it in the bank to be sure. I smiled. An answer. Both are wrong. The first one misses the risk, the second one misses it. Opportunity. As for me, I will keep 50,000 in government bonds and 50,000 on 10 stocks. Defense vote. Because I don't need to become a millionaire, I just don't turn out of the game now. Come with me a deeper dive into stock selection for defensive investors. I do not claim requires you to become an expert analyst, technical analyst or financial specialist high class. What I propose is a method, simple, clear, and feasible selection method doable for anyone with a heart, patience and a little discipline. First of all, the stocks you choose should come from large company, large enough to not be drafty if the market was blown away by just one piece of news. Rumor. I'm not talking about companies. Giant, but they must have scale, prestige, faith and history exist through several cycles. Economy. For a company that has survived Great Depression or war, the world will not collapse easily because of a low profit quarter. Second, let's choose companies with a history of paying dividends. That is, regularly for at least 20 years. That is a sign that the company has stable profits determined, know how to share with shareholders and stakeholders. The most important thing is not to overdo it. Neck like a warm blanket, not too much show off but help you get through the coldest day of the market. Rank 3, be mindful of the price you pay. Right, even a great company can be a bad investment if you buy it too expensive. I often advise my students not to buy hope, buy value. Mean. Consider the price to earnings ratio, PE, PB, price to asset ratio, and how it compares with the history of the company itself. If PE currently double the 10-year average, you should be careful. The market can more drunk than sober, but I know what I'm saying sounds sad. Plain, there is no excitement of those startup increased 300% in 6 months. There is no halo of sentences crypto life-changing story, and that's why few people follow the defensive path. But I confirm, if you are managing assets, family property, if you cannot let lost half of portfolio on one guess if it is wrong, defensive investing is not choice, that is mandatory. I used to say, the market is where money is transferred from person to person. Impatient to patient, and the defensive investor is the embodiment of that patience. They don't race, no, they are in a hurry but not passive. Observe, adjust and survive. Security. Nothing comes from knowing everything. It comes from knowing the limits of me. If you can't keep track of the market, school every day. If you don't want to stay up, wake up early to read financial news. If you find numbers tiring, if you are tired, do not force yourself to become one. A professional investor. Come back, become a wise investor and prevent. Wisdom is the condensed wisdom of centuries of experience. Allocate your resources strategically. Choose stocks. Foundation. Keep quality bonds, and above all, keep a cool head as the world around heats up. Invest. It's not a sprint, it is a long journey. And those who come the finish line is usually not the fastest person. The most important is the one who knows how to keep the heartbeat. I was the most stable throughout the journey. There is one question that always makes investors hesitate. Confused if I were just one person normal, not much time, don't want to bet, so should I invest in stocks? And I said yes, but it has to be the old style. Votes in line with the defensive stance. Don't think stocks are a people's game. Professional. Stocks, if selected, it can be a tool to preserve purchasing power. An effective long-term growth, even better than bonds in many circumstances seen. But here I want you to step in. Market with one foot on the ground, no expectations of getting rich quick, no dreams dreaming of breakthroughs that are looking at the neck votes as part of a long-term strategy term to build financial stability. This requires a set of selection criteria. Strict selection, like a fine filter, keep the gems in the middle of the beach chaotic sands of the market. I have build a set of stock standards for the house. First, defensive investment. Choose the stock the company's shares are large enough, means minimum annual turnover $100 million in time value. The point I write that number is not because the arrogance of big business usually have better resistance before economic and market fluctuations. They are like great ships at sea, maybe slower than small ships but not too slow, easy to flip. Second, the company must have a sense of solid financial position with the company industrial. I require current assets ratio with short-term debt of at least 2:1, a safety cushion to ensure the company no suffocation if cash flow is in trouble. Tight with the utility company, where there is a line. More stable money, lower requirements but must still be able to pay long-term debt from profit line. Third, there must be a schedule. Dividend history for at least 20 consecutive years. I emphasize the word continuously because dividends are not it's just money, it's a symbol of character. Sustainable, a company that knows how to share profits to shareholders consistently for 2 decades. Century is a company that keeps its promises. Rank private, do not pay too much for shares. Vote no matter how great the company is, if you buy at a high price, the risk is always there. Stalking, so I propose 2 genders term, price to earnings ratio PE not over 15. And price to book ratio, book no more than 1.5, and if you multiply by 2 this number, the result should not exceed 22.5. This formula acts as a barrier to prevent you dive into hot stocks but full of risks. Imagine the investor defend like a hiker mountain, no running, no jumping but each sure step they don't get carried away. FOMO wave, not following rumors. They choose stocks like they choose companions, have a clear history, stable personality, and not too noisy. I know there are people would say that is boring. Correct so. But in investing, boredom usually a manifestation of reason, while excitement is the shortest path to mistake. If you apply the criteria set this into the market, you will find that very few stocks satisfy all. And that is the key point. You don't need 100 chances, you only need 10 right chances correct, and if you keep that discipline, you has gone halfway through a family's journey. Invest wisely. There is one thing I want remember, there is no formula. Eternal, including the set of standards I just. If the market changes, businesses change, society and monetary policy also change. But the principles built on a foundation of prudence, logical and time-tested, are often more sustainable than strategies. Miracle only flashed for a moment. I'll tell you about an investor I know. Each instruction. He is not a financial expert, just a family doctor in a small town in Pennsylvania. Every month he set aside a portion of your income to invest. Steadily, slowly he applied the standard stocks I recommend. Never break the rules for 25 years. He never now buy stocks just because they are hot, and as a result, he did not become a millionaire. Right. But when he retired, he owned a rock-solid stock portfolio. Stable word, and never have to live in fear of the market. That's the thing. I call that real victory. Are not for the sake of extreme wealth but for the sake of security heart. Now let me consider other aspects. Defensive investment is not means passive. It requires a proactive in thinking and choosing filter, and most importantly, in the way you react when the market becomes volatile. A defensive investor may not changing the list constantly, but he always monitoring, always ready to adjust when the fundamentals are violated. Imagine a bridge. You don't need fix it every day, but you have to periodic check if the foundation begins bold. You must act not out of fear but out of responsibility. Category: so does your investment. I want to mention a popular shortcut that many the chooser. Investing in mutual funds. Only professionally managed investment fund or number career for defensive investors unwilling or unable to choose stocks. Vote this is a viable option. As long as you understand the costs, how it works, the operation and nature of such funds. Don't be attracted by the advertisements about the benefit superior profit, but seek stability, determine transparent and low cost. And finally, I want to talk about the beaten element. Lowest price but big impact, best in emotional investing. A catalog perfection can also collapse if the owner it's not stable enough. One more war simple strategy, if done properly, law can bring superior results in the long term. I have lived through many cycles. Market period, has witnessed the stocks votes were celebrated and then forgotten. Romantic heard countless people boast about profits and also see them silent when the market turn around in all the noise. What I always believe in is durability. Steadfastness is not about speed but about consistency. Restaurant: so if you are an investor, be defensive, slow down, be selective, build a portfolio like you build a solid house for your family's solid foundation. No need for splendor, just don't collapse when the storm comes. Friend, you don't have to be a genius, you just need to keep rational in the first world. Emotional financial peace, not from winning the market but from understanding yourself and building a system. The defense system is good enough that you will never now have to retreat in fear. When people we are talking about investors actively installing, the image that usually comes to mind is a person who is always looking for new opportunities, sharp, a bit reckless. I will start not by saying you should do what, by pointing out what you should be avoided. Because in fact, in investing, what makes people we failed not because they lacked war profitable strategies, because they do not know how avoid pitfalls. And proactive investors, because of wanting to achieve higher profits than the level the average person is more likely to fall prey of flashy but empty things, hollow. I once met a man who was suicidal. Recognized as a new generation value investor. He talked endlessly about models. Growth model, industry trends, stocks have the potential to triple. But when I asked how you determine intrinsic value, he could not answer. He no investment, he is speculating with a luxury coat. First of all, hot stocks, the market is always their names that are being hailed. Stock price skyrocketing, news spread. One said if you don't buy now you will miss the opportunity festival. And so people rush in for nothing. Understand the business but for fear of missing the boat. But do you know? History of U.S. stocks full of morning and evening stars. Those the company has been making waves in the press. Disappear as if never existed. If you buy just because the crowd is clapping, you will push to the back. When he clapped stop, followed by the group of stocks increasing high expectations. Chief, Grokstock. People are willing to pay 3 times the profit. Company profits simply because it believes it will boom in the future. But the future is a fragile thing, and when expectations are not met, come true or worse, just growth slows down a bit, the ballot will collapse like a piece of paper. Investors, be proactive, don't pay for it expected. He pays for the value. Can be proven. Then comes the stock group. Microscopic tiny companies with few people, no low transaction, cheap price to seem like an opportunity. But because it is small they are easily manipulated and easily priced. With a few big commands, it's easy to make people thought he found a diamond savage. While in fact just a piece of frosted glass glittering in dark. I know what you're thinking. What is left to invest? The answer is very many, but you have to learn to say no. Refuse what seems easy to eat, refuse the stimulation, rejection of new things but lack of foundation. That rejection is a sign of maturity in investment. Imagine that you are passing through a night market, the lights were sparkling, avoid bustling delivery sounds of all kinds, delicious food, the goods are displayed invitingly. And you with a thin wallet and an empty stomach must choose. If you just rush into every room goods, you will spend all your money before finding see what is worthy. But if you have a copy stuff, have criteria, and know how to say wrong at some point, you will leave the market with what you have. Really need active investors do not. It takes a lot to do a lot and it needs to be done right. Surname not the people who work 16 every day, reviewing each report line by line. Finance like detective. They are the people persistent, able to question oneself, does this make sense? And have the courage to put aside the attraction if the answer is or not. Be careful with stocks has a great history of profits. I used to see companies announce rising earnings grow steadily 15% 20% per year for a period of time decade. At first glance, they look perfect. Good, but when you dig deeper, you see that growth was based on loans. Ballooning debt or deferred expenses or unclear adjusted earnings. White financial performance is similar. Like a scoreboard, beautiful to the point of perfection when it is a sign of hypocrisy. Then you will encounter stocks colored by accounting techniques, revenues recorded ahead of time, the costs move to the next stage. Outsider looking at increased profits, cash flow fine. But the sober investor will ask, where is the real money? Quality of profit how? And if you can't answer, that's it. Is a signal to retreat. I do not say you doubt everything, but I advise never stop doubting. Still another trap. Stock issues new IPO, spin-up or S offerings. When the market is excited, you will see a series of companies launched to investors. Surname tell growth stories, make forecasts future and often have underwriters the issue behind the price push. But remember, when someone offers you something there, maybe they are earning more friend. A smart investor will not buying a stock just because it just went public. Also don't be lured by fashion companies. Above, the professions sound very attractive. Lead, technology, pharmaceuticals, energy clean. Does not automatically turn a business into a good investment. For one, businesses operating in the same industry attractive without competitive advantage, uncontrollable costs, or leadership weak morality is just a cover spectacular. And don't forget the paradox this. Sometimes companies have stories. The bad is where you should keep an eye out because when things are bad, stock prices often go up. Reflects excessive pessimism. And if you find evidence that the business has recoverable, you can find one bargain, but make sure you analyzing, not just betting on luck. The less action, the more effective. The higher the fruit if those actions carefully selected, good investors not a regular buyer. Surname is someone who can wait patiently in line months, even years without make any transaction just to make it right. A valuable decision, like an ambush hunter, don't shoot at everyone the prey passes by and just waits for the right one. Right time. I don't teach you how to invest, that I show you how to suppress, how to filter noise and how to avoid costly mistakes that most investors make. Overenthusiasm is a problem. Let's remember, you don't need to do more than the market. School, you just need to avoid doing things that the market is always caught up in, those positive feasible path. In fact, active investors can choose to seek returns that exceed the market. School. But before you go in, to clarify one thing, active investment is not synonymous with action much, it is synonymous with means doing the right thing. Not to buy sold daily, but is able to read out opportunities where others do not look, come and act on a basis. I'm not bring you the secret to getting rich quick. I bring to proven investment strategies, time-tested, unpretentious but effective. If you are patient enough and elaborate. First is the investment strategy. Into undervalued stocks, especially companies with high price-to-earnings ratios. PE and price-to-book PB is lower than average. Don't be confused them with stock price. Something that looks cheap but the potential risks are very high. Share underpricing in the true sense of the word. Businesses with stable financial foundations, have positive profits but are being marketed forgotten for psychological reasons or time. Do you know? The market sometimes acts like a fool. In love, blind and forgetful. Those the company that was once the focus may be left behind. Whereafter only a few quarters less impressive. And that is when the investor actively steps in, turn over the financial statements, look at the price's value and uncover opportunities. Or the second strategy is to look for companies that have high dividends. A stock with a dividend yield, i.e. 4%, 5% or more, stable over many years is often a sign of a business, real profitable business, not based on marketing story or distant vision. Sticky rice. While the crowd ran after the increased chief, you quietly collect cash regularly, set as a kind landlord collecting money rent. The third strategy is hunting stocks that are being traded underlying asset value. This is rare but not non-existent. There are the company, after a period of losses, went bankrupt. The shares were sold off to their total value. The market is lower than the amount of cash they have holding, or undervalued assets tangible. If you can verify that those assets are real, that debt is not too high, that the business is not in the middle, you just found the diamond. Steel in the mud. And finally, there is one special strategy I always reserve for investors who are diligent in analyzing and have high discipline. Invest in those the company was temporarily punished by the market times because of negative news, such as a lawsuit, a change of management or a profit adjustment period. There, the panic chaos often causes prices to fall more than normal. That the bad news itself deserves to cause. But only apply if you understand it well. Business, know what the bad news is. And believe that it does not affect the value long term, but there is a truth that few people talk about. Straight to you are the opportunities that I just said. The stock is undervalued, high dividend paying companies trading below asset value is not easy. Find, and if easy, it is not cheap. Investor proactively take advantage of opportunities. This cannot be based on rumors or charts. Price, they have to work really. Read the newspaper financial statements, cash flow tracing, mining deep into the history of governance, and sometimes waiting for many years. Patience is capital precious, but in an age where everything is counted in weeks, even in minutes. Patient investors are often overlooked. Is outdated. I have seen people criticize defensive strategies, say that value is dead. They buy stocks votes like playing games. Until the market turned around, they realized it was no one holding the phone is also an investor. People, a true activist is not a doer. Many are well prepared. He don't jump into a stock just because you see it. Red dip. He has criteria and limits. Deadlines, and be willing to say number 99 times just to act on the 100th time. And that, strangely enough, the market often rewards those who know. Wait, I bought a stock the year no one bothered to mention that company name. Its price is horizontal, even 10% off, but I know the line. Company cash is still good, market share is still maintained, the board of directors continues to buy shares of myself. I waited until the third year, the market realized that the stock price had doubled. I'm not surprised because I didn't buy it by emotions but by data. Don't either. Forget a vital principle. Never now borrow money to invest in stocks. Investor genuine initiative always uses capital. It is true that borrowing creates pressure. But pressure force in a volatile market is easy make you make wrong decisions. Maybe you true about stocks, but if using margin, you can get funded right in the middle of the street. When the market has not yet reflected the value real. I have seen many smart people fall down just by using lever. Don't let I became one of them. Ability, emotional control. Proactive investment means you are entering a battle with crowd psychology. When they are afraid, you need keep calm. When they are greedy, you need be alert. When they are excited, you need to incredulous. No software teaches you that. Only time and failure can be taught, and if you learn, you will become a real investor. Not because you are always right, but because you know how to outlast mistakes. Because it is not just a strategy manual, it is advice from someone who has lived a full life. Integrity in the market. If you want to go far more than the market, you have to be humble more than the market. Don't run faster, just go more sure. Don't do more, just do more correct. You don't need to win every battle. Time. You just have to not lose in those important times, and the rest, market the school will reward your alertness. Friend. I still remember the feeling the first time see the market crash, not as the number that is the face of the numbers people. Some people bow their heads as if they are wonder why this is so. People look feet to the screen with eyes not lightning, and there's someone I swear is sitting there laugh strangely as if at last everything has returned to its true nature. Chaotic. That's when I understood that the market is not must be a rational machine but a yard collective psychology. Each time the price changes movement, the thing that is really caught up in the air, it's not just money but the feelings of the customers. Million people hope, panic, greed, regret. And that is why, if you want to become a smart investor, you have to learn to face it, market fluctuations as a natural part nature of the game, no fear, no sucked in, not trying to predict. Let's see, it's like the weather, some days it rains, some days it is sunny. Sunny, and no one is foolish enough to sell a house just because of rain for 3 consecutive days. One often asked me if I should worry when the market school discount. And I always answer, worrying doesn't help pick up action, it is the coin that destroys the portfolio. Variable action is certain. Your reaction with it is where different results are created. Separate. Imagine you own a piece of land. A day a man strange knock on your door and say, "Today I want to buy your land for a price $200,000. The next day he came back, "Today I only bought $150,000. Today next I buy $220,000 and so on. Would you sell land just because? Offers change daily from one person of unknown identity. No specific reason, of course not. You only sell if you have your own reasons, need cash, want to reallocate, or feel valued. The land has reached a reasonable level. So why? Why do you act like that with stocks? Every shake of the price board is a shock. Land and volatile investing is your friend if you know how to use it properly. When the market is too optimistic and pushes prices up beyond reason, you sell. When the market panic and sell indiscriminately, you buy. This sounds simple, but in fact, emotions are your biggest enemies. People are not afraid of losing money as much as they are afraid of being hurt. Be wronged in front of others and people, not greed for profit as satisfaction when right in front of a crowd. Learn to separate yourself from that feeling. Investing is not for prove that you are smarter than others. Investing is about protecting assets and making money. It increases steadily. Even though how many people are screaming around it to help you visualize better, I would like to introduce an imaginary friend that I often used for illustration. Mr. Market. Mr. Market is a person partner with you in owning a business. Every day he comes knocking on the door, you give a number. Today our company valuation is $1 million. The next day, today I think it's just $800,000. Okay, I'll do it another day. Already. I buy back your shares at a price $1.5 million. Every day he gives out a price, but do you have to sell to him? Are not. Are you? Buy more shares from him? Also are not. He is just a waiter, the bidder, not the offer or command. And that is what most investors I forgot. Stock prices are opinions. Not true, it just reflects the mind. Market logic at a point in time does not reflect the intrinsic value of the business you own. Smart investors, I do not let the market lead me by the nose, they use him when the market price much lower than their real value. Buy. When the market price is too high compared to what companies make, they sell. Remaining part big time they ignored him. Thing sadly, most investors do. The opposite, when the market returns should be excited, they are also excited. When the market became panic, they also panic. And then they disappear, become a copy of the crowd, instead become an independent individual. I do not say you should become indifferent to the market school, but I recommend you develop a filter every time you see the market strong fluctuations. Don't react automatically. Power. Stop and ask if this price is right. Reasonable. Enterprise value has changed. My actions are based on analysis or emotion. Remember that volatility is not necessarily a bad thing. Goalkeeper. With the defender. It could be it's scary if they react wrongly. But for active investors, volatility is the key. Festival. No market days panic will not have attractive prices. Leading, without impulsive phases, there will not be times when you can sell priced higher than its value. I have lived enough long to witness the cycles repeat, market crash and recovery, then collapse and recover. Every time thus, the crowd again forgot the old lesson and repeat old mistakes, and the one who is not carried away is the one who has principle. People understand that change cannot be controlled, but how we react, the response is completely in your hands. The market is an emotional beast, you know. No need to be like it, you just need understand it so as not to be swallowed by it. There is a special type of investment that I often called the choice of the non-person have time. It is investment funds, or also known as investment fools. In theory, they were created to help those people who do not have enough knowledge and time or the patience to analyze the stock yourself. Vouchers can still be invested in the market. Safely and reasonably. Sounds very good, attractive, but reality is more complicated much. Why do people choose funds instead? Self-invested? Some people say it because they don't know. Stock selection, some people believe in their ability. Capabilities of professional fund managers' career, some people are convinced by outstanding achievements of a few names in the past, but I'll be blunt, most funds do not outperform, even most are not even equal to the market. When you subtract management fees, commissions and expenses, operating costs, then the fund's profitability average is usually lower than index SP 500. And that is a shocking truth for many investors over the years follow. I noticed that the difference between a good fund and a bad fund must always be at the forefront of strategy. Private. Sometimes it lies in the fee structure, where that the manager always makes money. As for investors, it depends on luck. I used to meet a small investor who was very inclined to read newspapers. Fox asked me if I should choose funds, has had an impressive record over the past 5 years. I looked at him and asked again, are you sure? That the result comes from ability, not luck, because of what I learned from the market is the past not guaranteed proof for the future, especially in the mind. Private. Imagine you are choosing athletes to bet on the race marathon. You see a person who won 3 recent, so you pick him. But you don't know that in 2 meetings opponents had injury. And the second 3, the rain made the others run slow. That is, good performance is not available. Means good ability. That is the problem. With many investment funds, people often be seduced by the record without learn the process thoroughly. They see the benefits. Double digits, but not considered how that profit is generated. Have a hit 7. Is there speculation? Have luck or not? So smart investors must what? First of all, let's distinguish between the two. Fund type: active funds and passive funds. Active funds have a management team that makes decisions. Continuous buying and selling to beat the market. School, passive fund. On the contrary, simply simulates an index like SP 500, don't try to beat, just follow. And if you ask me for advice, I will give it. Index funds are the most logical place to start. For 95% of investors. Because of the low cost, transparent, and most importantly, you don't fooled by expectations. But if you still want to pursue active funds with the hope that somewhere there are still people who can beat the market, I don't stop, friend. I just suggest you set those. Ask yourself the following question before investing your money in any investment. Any fund first, what is the cost of the fund? How much? Management fees can be as little as 1%, 2%, but when added up over the years, especially with compound interest, it can eat away significantly. Your profit. A fund achieved 8%, but charging 2% actually only generates 6% for friend. While the market may carry 7% return with almost no fees. Index fund second, the fund is transparent. In the report or not? They have announced clearly investments change the list item, cash holding ratio or ratio portfolio rotation. If not, you investing in the dark without knowing it. What am I holding in my hand? Third, the manager does the treasurer eat with you? That is, they use personal money to invest into their own funds. If not, you should be suspicious because no one has a motive. Keep other people's money more carefully, your own money. I have analyzed a fund that looks very attractive, performance good, big brand, good team, EV league. But when I went deeper, I saw the ratio portfolio turnover rate up to 300% per year. That means the average price per share kept for less than 4 months. This is not investment but transaction and cost included, tax, commission, price difference making the actual profit almost nothing. How much? In contrast, there are simple funds buy only quality stocks to keep long-term, unchanged and correct that boredom produces outstanding results. Long-term advantage. One more problem. It is important to note that there is a herd mentality in the industry. Fund for fear of being left out if the market increased sharply. Many managers are willing buy hot stocks even though they are no longer cheap, just for the scoreboard looks trendy. As a result, you are paid to receive a copy of the mob winter. Investment funds cannot replace investment. Investment only if you invest in the fund with someone will take care of you. You are bet on randomness. Fund whatever. No amount of achievement can save you if you do not understand the risks. Do not goal-oriented and unbiased. Separate switch. Consider investing in funds like hiring someone to drive you. Friends still have to know where you want to go, how much gas, and is the road potholed? Are not. Otherwise, you are just a passenger. Was sleeping in the middle of the journey. I don't know the destination myself. Give. So if you don't have time, know if you want to track individual numbers, an index fund is the way to go. A wise choice. If you have any idea conscious, want to find high returns more, be ready to work seriously and independently evaluate active funds. And even though whichever path you choose, always remember the main thing. You are not the fund that is responsible. Responsibility for one's financial future. Be honest with each other. Invest not easy. It's not just about picking the right stock, coupon or index tracking. It is a time-consuming, demanding work, knowledge and above all, a stability of mind reason that not everyone has available. That is why many people turn to one instructor, a financial advisor. But here, I'm not telling you about great consultants can help you get rich quick. I want you to understand, investor-advisor relationship. Finance is one of those relationships. The most fragile in the financial world. I have witnessed many scenes. An investor walks into the office and makes a deal. Your entire catalog to one person that he just met, just because the other person ate, dress politely, speak confidently, and show off impressive achievements in the past 3 years best, but 3 years does not make a difference. Career and a beautiful report does not say the whole truth. So what do you need from one financial advisor? I will say it right away. Are not the best stock picker the person who knows you best. Financial advisor, not a fortune teller. He doesn't predictable market. He doesn't can guarantee profits. The only thing I have what we can and should do is help you understand. You are investing for the sake of what? How much risk are you willing to take? Friend, how to react when the market crashes. A good advisor doesn't give you the answers. Correct answer. He asked questions correct. Did you know that most of the bad investor decisions from ignorance but from overthinking, confident or too scared? And an advisor, if done correctly, the main role is to be the keeper. You are in between those two extremes. He doesn't lead you and walk beside you close enough to keep you sober, far enough away that you still bear it yourself responsibility. I once met a consultant named William. He never talks about her hot coupon, never promise profit, high profit, never make customer excited. But you have something that I appreciate more than perseverance. Guessed his customers are mostly people. Normal. No one became a millionaire in 3 years but after 20 years. Most of them all have a solid asset not because of beating the market but because of not being beaten. The market misleads. There is one interesting paradox. Many people come to try financial advice with the desire to be guided smart investment but not readily available, ready to hear what is really needed. Listen. They were expecting an affirmation, a boost to shaky confidence, rather than a serious rebuttal. And if the advisor is not competent enough, he will become a mirror customer expectations instead of becoming guide. That's why I press strong choice of advisor. First, choose one people who dare not please you. You need one. Might say, I know you want to put all your money into tech stocks, but that doesn't make sense. One person. Dare I say, I'm not sure you're ready for this change. A person who when market red school fire will not call to reassure. Cliché that will sit down with readers, review the plan, remind yourself why I invest first. Of course not any problem is good. I will not draw one pink picture. Financial consulting industry. There are quite a few market followers, sell financial products with high commissions and hide the real purpose behind the shell. Expertise. They don't advise, they sell, and they don't guide, they steer. So, to choose the right advisor, you need 3 criteria. Well, first, they must be transparent about what they earn. Where does the money come from a fixed fee or a commission? From financial products. They have investments together. You don't. Are they willing to give full information on past performance? If not, leave. Second, they must have long-term thinking. The person who promised to help you double your assets in 6 months, the reward is the one who makes you lose everything within 12 months. A good advisor will not attract you by achievements but by understanding and planning ability. Fit. Third, they must clearly understand the role of mind, to be a companion, not must be operated by a person. They help you keep discipline, they criticize emotional decisions, calculate. They are the compass in the storm. Market psychology. Perhaps the important thing, especially never give up all power decision for anyone, including the called experts. Financial advisor good will always emphasize that he is the one, the person ultimately responsible for my money. I can give advice, but you have to understand, believe and agree. Go with it. You are the boatman, the financial advisor is the map keeper and map. If you believe that you will not, whenever you are in a thunderstorm, you will think to yourself no need anyone, but when the storm comes, you will see the value of a person who knows orientation. No screaming, no spinning thin, just quietly pointing at the direction you forgot. Let's choose the right person to go with, and remember one thing. Good advice is not your word want to hear but the words you need to hear at the right time. I once joked with my friend that the greatest grace of the average investor is not become an expert, but that is a saying that encourages lazy people in reverse again. I want you to understand that analysis securities are not the privilege of the street expert world, normal people. If you have the right mindset, it is still possible. Analyze and select stocks carefully. Effective, simple approach, reasonable for ordinary investors can evaluate which stocks are good. First, ask yourself, what makes a good stock? People will say speed, growth, profit margin, market share. But I will give a simple definition. Simpler and more practical. One share good is part ownership in a business. Really good karma sounds obvious, but how many people buy stocks? Coupons because they think they are buying a piece of business. Most just see it as a code, a number, a chart. Surname can't see behind is human, machine hooks, strategies, and even meetings deciding the fate of thousands of workers. So the first step in analysis is view business as a living entity, not a command line. Look into profit line. It is not just number. It is the result of millions of decisions. Operating conditions. If profits are stable or steady growth for at least 7 years, 10 years, you have the right to believe that the company doing something right. Next is financial situation. The company has too much debt. How much of the loan is interest? 100 profit. Ability to pay interest if profit halved. If the answer is no, you should move on. To the dividend rate. The company pays dividends regularly. Not because you need the number, that money, because it shows the sharing mindset and capital discipline of the board. And of course stock price. I repeat, do not buy, hope buy value. If stocks with PE below 15 and PB below 1. 5 like I would suggest that at least you are buy in safe zone. One point I always emphasize to homeowners: amateur investing is something you don't need have to analyze everything. You don't have to is a financial doctor who examines each patient. Business, you just need to screen the breed. Like a goldsmith knows where to look real gold, where is the plating. Want to do it. For that, you need some clear principles. Clear first, check the revenue and profits over the last 10 years. No need for numbers, just understand the trend direction. If revenue increases steadily or at least not a sharp drop, that is the sign, shows the business's ability to survive long-term. Profits too, don't find growth too fast. Find the regularly, because regularity often reflects core operating quality. Monday, consider the debt-to-equity ratio. I used to said, a company with debt is like a person with borrowing is not bad as long as you know how to pay it back. If total long-term debt is twice the owner's equity, friends, be careful. And if short-term debt beyond current assets, you are standing before a potential debtor is not business. Third, profit margin line must be healthy. With manufacturing companies export, I like to see profit margins on 5%, that is, for every 100 dong of revenue, keep got 5 profit. Again, small number but sustainable and risk-free. Fourth, real cash flow. Book profit. Books are sometimes accounting magic, but cash flow, cash in and out, is real. If a company is profitable but cash flow is negative money for a long time, maybe they are selling on credit too much or wasted investment. Both are all red signals. I know many people feel tired of reading financial reports, but I will say this. If you can't spend an hour to understand a job tie, you shouldn't own it, because you don't buy a lottery ticket, you are buying a part future. Another common mistake is too much trust in big names. I saw many large companies collapse because of internal turmoil. Thread, fuzzy strategy, or governance greed. And I also see many companies small, few people notice but quietly accumulate value over the years. Set a target minimum standard such as filters, and then from that selects a list of suitable stocks fit, and then do nothing, just follow regular monitoring, because investing is not continuous action but persistence with right decision. Finally, know to turn you into an analyst mini that helps you step into the ancient world. Vote with a fresh eye. Friend, you don't need to know everything. You just need to know enough to not get caught up in the crowd and not controlled by emotions, because when you view stocks as part of a business, real karma, when you know the CEO's name, understand the products they sell and read the transfer, move through the numbers, then you're no longer a gambler at the table contract, you are a co-owner of the agarwood. Lazy but smart, humble but capable, courage, and just like that, you're getting closer. Much more to the spirit of a home real investment. Imagine you reading a financial news headline: First Note Abi Company achieved a profit of $4.25 per share in the last quarter already. Looks impressive, right? But the question is, do you understand your child? What does that number really mean? Profit earnings per share or has long been one of the indicators, the most common number for valuing stocks. It was featured in a headline of the article. Quoted broker, reported financial bold, but I have to say real, is one of the most easily understood indicators. Biggest mistake if you don't know how to set it in context. First, understand the what is EPS. That is the profit line of company divided by the number of shares outstanding circulate. Sounds simple, but it's actually quite difficult. Behind that number are countless adjustments, procedures, accounting techniques, and decisions. Subjectivity of the board of directors. Company can increase FPS by buying back shares. Vote, that is, make the denominator smaller. No need to increase profits. Look at the surface. EPS increases, but the nature of value created for shareholders is not certain to change. Or the company can sell the asset, recording an extraordinary profit, and then added, but that profit does not repeat. That's it. Does it really reflect operating performance? Are not. I once saw a company report. Company in the construction industry. EPS increased sharply for 2 consecutive quarters, investors cheers, stock prices rise, but when I flipping through each line, I see the profit. Increase mainly from provision reversal expense. That is, the company says, previously I thought it would cost 50 million, but now it only cost 20 million, so I added 30 million in profits. That is not creating value, that's sophisticated accounting. So what I want you to remember, the point is never to take EPIS as the truth. Think of it as one of many pieces of the puzzle. In the financial picture. Now let's digging deeper into how APS can be squeezed, distorted not due to blatant cheating but by legal but lacking tricks, transparent. A common example is the adjust margins to improve results. Precious executives are often responsible. Pressure from Gold Street, where profits are expected next quarter's profit must be higher than the previous quarter's. And when actual profits are not enough to make to satisfy investors, they seek measures, creative methods. Sometimes it's just a delay. Fees, sometimes early revenue recognition. All of these things affect, and if you just look at the numbers, you will know visible muscle tension behind. I once saw a tech company report a profit large while cash flow is active again minus. The reason they record revenue from contracts 2-year service contract. Right in first quarter, EPIS looks good, stock price increase in votes, board of directors receive bonus, but in fact the company has not collected get a penny. That's why I advise smart investors not to single view compare EP with the line cash from operations. If two numbers go well together, if they are different, ask questions. Another factor also often overlooked. The impact of inflation to EPS. In times of rising prices, input costs increase but not necessarily reflected immediately in the income statement. Enter especially for companies using first in fest accounting method, meaning is air pace can be temporarily blocked because the cost of inventory is lower than the replacement cost. Reality, you see the profits but the company is under real pressure. And don't forget the number of shares circulate because it can change a lot in a few years. If the company issues add shares to raise capital or merge, EPIS merger or split will be affected. Enjoy, sometimes have nothing to do with business activities. What does that mean? EP increase or decrease is not always also tells a business story for better or worse, so I always suggest you compare the current EE with apps of at least 7 to 10 years ago. Don't compare every quarter, look at the long-term cycle. Ask what the trend is. Is it stable? Or not? Does it depend on any factors? Usually. And if you have enough time and be patient, I advise being neutral. Averaged over 10 years instead of just taking the numbers latest, you will get a look less glossy but closer to reality. Remember, EPIS is a product of accounting and value is a product of reality. Friend, cannot rely solely on epistemic investment decision. You have to understand how it works. Create it and put it into action. Real business. Don't let one the single number that determines your wallet. You in the investment world. The simpler, the more you overcompensate, the more vulnerable you become. Look with a clear eye. Don't believe it. Into continuous growth, if not controlled, check its quality. And always remember, AppStot is not a sufficient condition to buy stocks or just a door for you begin to enter into a comprehensive assessment. I often asked, so how to apply the principles he speaks of in practice? My answer is always by comparison. Compare. There is no clearer lesson than this. How you put two businesses side by side, dissecting the financial structure piece by piece, strategy and pricing, then let the differences speak for themselves. Now I choose out 4 listed companies, no must be criticized, nor to be praised that to you. Investors are learning. Ask, can see clearly how the numbers similar, can tell stories very different. Let's start with Company A, industrial manufacturing enterprises with very good profit growth rate in 10 years. Their EPIS increased steadily, that is also maintained stable, debt ratio low, positive cash flow. Basically, this is a healthy, financially sound company. Strong, but its stock price is trading at a very high PE because of the market too optimistic. That's what makes me hesitate. Because I learned that even the company good if bought at too high a price also becomes bad, become a bad investment. Switch to work. Company B, a consumer electronics manufacturer. Use. Their profit growth is not regularly, but when looking back over the decade, overall stable. The leadership has ideas. Be cautious, do not borrow too much, only maintain reasonable dividends. In particular, the stock price current shares are lower than book value. Books, an opportunity few people see but can become a rough diamond for visionary investors. Then comes the work. Company C, this is a very popular company. Like on the market. Press praise, individual investors rushed to buy. Profit skyrocketed in the last 2 years. But when I looking closely, I see that the profit comes from sale of assets and recognition of revenue not yet implemented. Not from core business activities, core, negative cash flow, high debt. But because of the sentence, the growth story is so attractive, people buy with your eyes closed, and that's the kind of business karma holds me back, because I don't invest in the story, I invest in reality. Finally, Company D, a mid-sized, profitable energy company, not impressive but very stable. Board quiet but effective executive fruit. They failed to attract attention. Media but has remarkable durability, astonishment in crisis, low PE, next steady cash flow. The picture is a bit boring. But the truth boring, that is where I feel safe the best. Now let's dig deeper. Each case to see the difference clearly. It's not in the surface numbers, it's in how we act. Understand and decode those numbers. With Company A, the most outstanding feature is speed. S growth steadily for more than 10 years. The market looked at that and immediately labeled it a growth superstar. The company's stock price was pushed up. PE level is more than 40. It means that investors are willing to, the floor pays $40 for every dollar of profit annual. But is a public company, cyclical industries depends heavily on public investment, worthy of such a high valuation? I am not against a company increasing, chief, but I always question the level. Does that price reflect irrational expectations? And when you look at the industry cycle, costs, raw materials and global competition, I don't see a thick enough safety margin. This Company B then went in the opposite direction. In contrast, EPS increases slowly, even year past. But the dividend rate is very attractive. Leading, more than 4% per year. Regular payments and uninterrupted since the 1950s, low debt ratio, and what impressed me was how the board of directors retains the majority of the profits to reinvest in equipment. Are not flashy but effective, stock price trading at a PE of just around 9. An incredibly low level for a company with such a solid history. While the market rushed into rising stocks. The chief here is a valuable opportunity. Probably waiting for someone patient enough. Company C. The most interesting case is the lesson classic of the profit illusion. EPS increases, sudden change thanks to asset sales, real estate, plus a lawsuit that the company unexpectedly won the lawsuit and took back the goods. Tens of millions of dollars all added up profit, and so AIRP jumped into the market school. As usual, no source asked original, just look at the result. Stocks up 30% in a few weeks. But when we filter again, EPS from core business actually decreasing. Not only that, the ratio, high debt to equity ratio and negative cash flow. Things that investors get caught up in. Price increases are often unrecognized. I'm not say this company is a scam, but I'm sure make sure that the sudden profit never happens. Sustainable hours if it does not come from energy core force. Finally, Company D is the largest. Represents the average business in a respectable way. Slow revenue growth, not outstanding, but dividends are paid regularly like clockwork for 20 years. Balance sheet almost clean, debt, expenses are paid, good control, no explosive jumps but no slip harmful. The stock trades at a PE of about 12, reasonable, not cheap, not expensive. This is type of stock that defensive investors should be seriously considered. It doesn't make you get rich quick but can help you rich for sure. When comparing all 4 companies, what I want you to see is not choose a company that is learning to be discerning business through many layers. E-space not enough PE, 1/4 profit insufficient. You need to look at the whole journey, the whole structure, cash flow. And importantly first, you need to understand how the market is misunderstood, because smart investing doesn't come from being better than others, from being calmer when others is being shaken. Remember that when the market pushed the price of company A up to the sky, that's it. Not the time to run after when the company C was praised, it was not the time to excited, and when company B and D are neglected, forget. That might be the time you should come closer and take a closer look. And like me has always said, investing is not about choosing best company. Investing is choosing a company most reasonable price with margin of safety whole. Let's say you are someone who doesn't like venture. You don't want to have to wake up every morning, turn on the computer, open the price list and stretch straight when red is dominant. You don't have time to read each line of financial report main, and also do not want to have to learn modeling detailed pricing model. You are not looking make a big hit, you just want assets, your own sustainable profits and low risk. Throughout my career, I have always emphasized strong, defensive investors are not weak investor, but one who understands I can't win the war through trust Gold Street, so choose a road less stormy. Few storms are absent, meaning random. You cannot choose stocks that people say are good, see the price is cheap. Defensive investors, there needs to be a clear, easy to apply set of criteria, but still tight enough to eliminate risk latent. So what is that criterion? 1. The company must be large enough. I once set a milestone. Revenue of at least $100 million. Calculate at current prices, this figure can amount to billions. The reason is simple, the large companies often have a management system, supply chain and resilience better. Crisis. Don't be fooled by small businesses with potential high growth, because growth has not happened yet is not an asset. 2. The situation finance must be stable, no long-term debt exceed equity. Financial ratio current assets versus current liabilities must be from 2 or more. Business cannot last steady if you are straining to rotate money every quarter. 3rd, dividend history must be clear. I want to see the company split its stock steadily for at least 20 years. Without interruption. Because dividends are divided equally. Not just a sign of healthy finances strong, but also reflects the mindset of giving back shareholders rarely seen in companies. Only promise but no action. 4. Stable profits. The company must have profit for at least 10 consecutive years, no negative profit year. A business, no matter how big the business is, if it has 5 holes, it is a failure. Like a ship with a hole. You never know when it will sink. Year reasonable profit growth. EPS 5. No need to double, no need to break change, just need sustainable and reasonable growth. Reason, because I'm not looking for a dark horse, I'm looking for walking buffaloes. 6. Definition reasonable price, stock price should not be too high. Expensive specifically, PE not exceeding 15 and PB not more than 1. 5. I even suggest a formula, if you multiply PE by PB, the result must not exceed 22. 5. This is a double barrier that keeps you away. Stocks inflated by psychology. Imagine you are walking through a door. Stock forest, thousands of bright names, lights, each one attractive in its own way somehow. But if you are a homeowner, true defensive investing, you will not attract it to light. You go slow, you have the map, you have the criteria, you filter. And that's what I suggest you do with the above principles. Act as a filter. Apply it mechanically, not emotional, inflexible because of self-discipline. That law is the most important skill that defensive investors need. You will likely find that after applying the above criteria, list of stocks remaining is quite short, maybe only a few dozen name in the entire market, and you will feel wondering if I missed out anything. I say this, and it's not bad to miss a rally by holding a bomb. Remember that your goal is not to beat market, the goal is to protect assets, make a steady profit and sleep well at night. You don't need a stock that goes up 300% in 1 year. You just need the stock to increase by 7% each year. Years and 30 years without breaking the bank product or panic on the road. I used to met a friend named Richard, a person with absolutely no experience private. He did only one thing right, use the 6 criteria I just mentioned to filter stocks. Vote once a year, he checks again. List, rebalance if needed. Older brother, don't read the news, don't look at the price list, don't listen to investing podcasts, just simple buy, hold, receive dividends, and do other things. 30 years later, Richard's retirement assets 4 times higher than the average person same age. It's not a miracle, it is the power of a simple method maintained with absolute discipline. I know some people will say, but the market change. How can one apply forever? Fixed formula. Yes, the market changes. Change. But what I propose is not the formula but the principle. The principle that good stocks need business, strong industry, healthy finances, and reasonable price. Whether you are in 195 or not, or 2050, that's still true. Only mind investor psychology is fickle and often change in direction, easily caught up in illusion. Imagine selecting stocks for investors' defense. So it is not art, magic, or game of chance. It is one. The filtering process is steady and emotionless. Place you only keep the businesses that have proven ability over time, and part reward you is not excitement, encouragement, but peace of mind. You will never know the people cheering for big profits in a quarter, but you won't be either. People panic when the market is red. You will be the one walking quietly among the crowd. Winter. Knowing that I'm not the fastest but will be the one to reach the destination safest. And if investing is a journey, then it is more precious than any quick increase face. The defensive investor is the one who chooses sustainable path, less action, more principles and discipline, like a rock. But if you are proactive and have time, knowledge and willingness, work seriously. However, I have to forewarn, proactive investors not the one who goes against the price but systematically biased opportunity hunter system. I used to call the investor proactive. Like a gold digger in a mine, old, no one guarantees you will find it. What? But if you know where to dig, know how to look at rocks, know how to remove sand and dirt, you will have the chance to find what the market is looking for. Forgotten school. So let's start from where? The first answer from the ancients' forgotten ballad. It could be those the company has stable business results but not noticed by the media, or names that have had scandals, information but has recovered financially. Or simply small companies don't have enough sexy to get the attention of institutional investors. Arrive. I once discovered a company, medical device manufacturing, stock price of they trade at a PE of 6.4% dividend, positive cash flow, no debt, long term. The reason why it is so cheap, no one knows them. No house which world is mentioned in the report I purchased. And 3 years later, when a large investment fund started, the head gathered in, the price doubled. Lessons learned. It's not my luck, it's the market. The school doesn't price everything the same. A moment. If you take the time to go through the area at night, you will see diamonds unpolished. An effective strategy. The fruit for the active investor is hunting. Find sharp stocks, that is, companies whose market prices are lower current asset value. CR asset minus all liabilities. In other words, you are buying a company at a cheap price, more than cash, inventory and receivables after deducting debts. It sounds hard to believe. But this type of stock really exists. Especially in market periods, bear market or extreme pessimism. I has built a portfolio of 30 stocks, such sharp votes. Each share is allocate the capital equally and leave it alone 2 years. Profit results far exceed the market. Public school. Even though some companies went bankrupt because the safety margin is so large, only the number is needed. Little recovery is enough to bring superior performance. Dominant. However, you do not always also found sharp stocks. Modern markets rarely let stocks fall down to such cheap levels, unless there is a crisis, panic. So I propose a strategy other by slow growth companies have stable asset value but market skip school. The key here is no attracted by growing businesses, hot head looking for names that have stable cash flow, clear tangible assets, clear and stock prices have not yet reflected internal force. Think of companies with a high turnover rate, low price to book ratio, PB below 1, too low debt. Profits do not decline in times of economic contraction and special circumstances. No false rumors or incidents. Major legal action. You don't need stocks hero, you need undervalued stocks wrong. In addition, active investors also can find value in bonds, convertible or preferred stock, especially when the market is not interested in a convertible bond into common stock at a price permanent. If the stock price increases, you can be converted to benefit. If not, you still receive regular interest. One such hybrid investments offer two protection layer, steady cash flow and potential growth potential, something that few people pay attention to in the market search phase. Big hits. I have to be clear first. Proactive thinking is not easy. It requires initiative. Real action. Read financial reports, follow the industry, understand corporate governance and especially the ability to make decisions when the market is going against you. But the reward is worthy not only in terms of benefits profit but also the feeling of control your own financial destiny. I'm not encouraging you to become a stock hunter fanatic. Vote. I just want you, if having chosen the proactive path, do it. That with the mindset of an investigator, methodical, disciplined and willing to wait until everything is just right to act. Active investing is not journey wins by speed, it is the gameplay of understanding, patience and all humility. Because the market does not reward the best person, the person who makes the fewest mistakes in the world invest. There is a special group of assets that very few investors understand correctly or dare to touch. They are not stocks, not quite a bond either. They are half this and half that, half solid. Sure, half promise. I'm talking about fruit. Convertible notes and warrants. I used to call them whispering winds full of temptation. Because on the surface they looks perfect. You just received interest rate like bonds with transfer rights, convertible into common stock if price increase. An attractive offer. Profitable when prices do not increase. There is a big profit if prices increased sharply. But in investing, any product that sounds too good to be true is worth it. Doubt and converbard are no exception. Let's start with the essence. Bonds. A convertible bond is a bond with rights converted into common stock of the company issuer at a specified price before. This means that if the stock increase beyond the conversion price, the house investment can be converted to holding shares votes, taking advantage of the momentum. And if the stock price, the coupon, doesn't increase, you still get interest, periodic interest like ordinary bonds often. Sounds very simple, but the question is more important: is the price you pay for what is this ideal? The problem lies in convertible bonds. Usually have significantly lower interest rates than with regular bonds of the same company. You are sacrificing part of the lion's share money to buy an option conditional, and if the stock does not increase, you are not compensated for the risk taken. Bear. I have analyzed a convertible bonds issued by a company retail industry issuer. Nominal interest rate meaning only 3%. While their traditional bonds at the same time is 5%. This means the investor is paying 5% per year just to hold the right to buy shares, future votes. But not clear neck whether the vote will increase or not. That's the price. Very expensive for something that may not happen. Many investors are attracted to bonds. Convertible notes because they think they have security risk. If the stock goes up, they make a profit. Large, otherwise they still get interest rate, but the truth is not as simple as that. So, the problem is you don't really own it. Two separate properties. You are holding a hybrid tool, in which both the left and right parts, both the stock and the shares, have been diluted. Dilute to make room for combination. Part. The interest rate you receive is lower than average, usually because you are paying for the rights conversion. The stock purchase rights part is not attractive enough if the stock price significantly increased. Conversion and market share. School is not always indulgent. Your heart. Multiple convertible bonds issued under market conditions. Favorable market when businesses can offering unattractive products, but there are still buyers because everyone is lost. Mandarin. The company prefers to issue this type of public company. This tool because they get loans with interest lower, while also having the opportunity to push up stock prices. Vouchers when investors transfer teams. Still home invest a lot when buying just because it seems good. One of the common mistakes is pricing of convertible bonds as bonds traditional ballots. Many people look at face value, term, interest rate and then think that I am receiving an investment stable, but they forget that when the fruit convertible bonds, fair value its price fluctuates greatly with the stock price. Shares, especially when the stock is near its conversion price, so it behaves like a stock masquerading as a bond and you don't expect stability like the left. Legitimate vote. Now let's talk about warrants. This is a perfect tool, completely different. A warrant gives you the right but not an obligation. Buy stocks at a predetermined price in a certain period of time other than left. Convertible notes, non-refundable warrants, interest, no return of principal and usually comes with additional bonuses in development deals. Issue bonds or preferred stocks. Sounds simple, but warrants are extremely difficult to price because it depends almost as entirely on future expectations. Price: what will the stock do? The market will do. How will the reaction be? How big will the volatility be? And I have to say straight, if you don't good at pricing options, don't touch into warrants. I once saw a job: emerging technology companies go public with warrants to buy additional shares in price $30 when the stock is trading at $27. Investors thought they were about to get advantage, but after 2 years, the stock price not only did not exceed $30 but also down to $18. Warrant expired, worthless value, stocks fell sharply and buyers lost money heavy. Because they overvalued something. Never happened. Warrants also diluted very quickly if the company issues add shares, split, or change capital structure. You think you hold a golden ticket, but the company can print additional tickets at any time. So the key question is: smart investment should invest in convertible and warrants? Answer: my word is only if you understand clearly what are you buying. If you invest in convertible bonds as shares with insurance, you can be disillusioned. If you buy a warrant as an option free, you can lose it all. But if you are an active investor, you have the ability to deep analytical skills, understanding of valuation and availability, willingness to accept quantified risk. Sometimes in market periods panic, the convertible issues can become a profitable fulcrum. Imagine for defensive investors, I still advise to stay away. Stay in the safe zone. Choose solid stocks, clear bonds. Business is real career instead of chasing after jobs. Have promise, have potential, because the end in investing. Simplicity is the key. Law always prevails over complexity. Attractive people often learn by reason. Theory but mature with experience and in investment. Nothing changes. Get lessons from reality, especially as when reality is full of paradoxes and mistake. This story is a walk through 4 companies, 4 stories to show you the theory of intelligent investing, only valuable when illuminated by market alertness. Let's catch started with the first. Region Company. This is a gas production enterprise. Industry with a long history of operation. Life, solid balance sheet. Dividends are paid regularly for nearly half a century. In 1949, Berkshire stock is trading at strangely low P/E is only about 5, that means you pay $5 for every $1 profit. Profit, a brain-dead valuation if looked by today's standards, but the thing is, what's more strange is that the market is completely indifferent. No bad news, no crisis industry, no financial fluctuations. Only simply the market is used to considering public this company is boring, and that boredom makes it was abandoned. My colleagues and I decided intend to buy. 3 years later, the stock increased double. Not by any miracle, just for the end market. Realize obviously, this is lesson number 2. Best. Low price plus quality, stability plus patience equals 100% reward. No luck needed, just enough cold to not follow the times. Top. The second story is about the company was called Emerson Electric, a typical example of a business model. Real growth. At the time I beginning to observe, Emerson had a series of almost uninterrupted profit growth period of more than a decade. Dividends also steady increase, quiet leadership, not pursuing big deals or breakthrough ambition. They only focus on one thing: improve operational efficiency and expand market share. Slowly but surely. Market. The school was in no hurry to love Emerson. For many years, their stock has not called hot stock. But if you hold during that period, profit, the return far exceeds many names. Peak growth of that period. Those the name rose like a kite and fell like a rock. Break. Lesson 2, Growth. It doesn't have to be spectacular to be worthwhile. Believe. A business that does the right thing, keeps true commitment and growth with energy core strength is often a safe haven. Best for patient capital. Come to the sentence. Third thing, Lin Tem Kovo, is when you see the dark side of surface growth outside. LTV stands out with a series of brands, business acquisitions, growth, revenue, and profit from merger fast, intense, impressive. The media. The announcement of LV as a symbol of modern management capacity, investors rushing into stocks because they don't want to miss out future ship, but behind the light halo is a desirable financial structure. Debt breeds debt, profits are diluted, and the nature of borrowed growth is clear. Obvious. I observe LTV not because I am offended. Attractive because of wanting to understand a business. How long can you fool the market? Financial tricks. Answer, not too much long. Stock crash after few years, house heavy investment loss, but worth it more than anything. Most of them don't understand why. That is the third lesson. If you don't understand how businesses make money, don't invest in it. Whoever is buying is NVF Corporation. More complicated case related to one of the players. Legend of Go Street, Burnett Conference. NVF is a small company be noticed until of the largest acquisition ever, itself a classic snake swallowing elephant scene image. When the deal goes through, the stock price NVF increased rapidly. Media call here is a Go Street rule bender. I then call it a reckless gamble in disguise. Creative. The truth quickly emerged. After NVF deal carries huge debt. Lacks management and falling into crisis. Liquidity. Investors are optimistic. Victim, stock back in place initially, even lower. Who are the first? According to the Rio Ho, the person leaving the last banquet when the lights went out, song. The final lesson was bitter but necessary. All strange but attractive deals are needed viewed with cold reason. If a small company dreams of capturing the whole elephant, you don't. Should clap. You should ask if it has enough teeth. Are not. For stories, for different fates different but have one thing in common. They all teaches you that investing is not an art, fortune telling is science, learning of understanding the present. Please select companies for intrinsic value, not must be because of rumors. Buy with security, not with hope, and always stay alert even when the crowd is mad. Because in the end, like me, always emphasize wisdom in investing. It is not in the ability to predict but in the ability to create. Ability not to get carried away. Now you entering a stock market is not for buy now and learn how to differentiate. First your face are names that seem similar, same industry, same scale, same politeness, but there is one thing you must know, similar in appearance no meaning the same in value. 8 pairs company, each pair like two people playing together, same song but with different instruments, similar sound, but if you have a keen ear, you will notice the difference. Sometimes it's a whole nature are General Electric and Westing Electric. Both are industrial conglomerates. Leading, long-standing and active in many high-tech fields. At the time of comparison, Westinghouse had lower P/E, looks cheaper. But when looking closely at the profit margin, management quality, and revenue stability, import, G proved to be superior. Does stock more expensive but not expensive considering the value, safe and effective. Cheap does not mean worth buying. If that cheap thing hides a unseen risk factor. The second pair 2, Biscuit, later Nabisco and American Home Products. 2 consumer companies. Essential use. Biscuit has revenue larger but with lower profit margins. AP on the contrary, slow but steady growth, very low cost, no debt and maintenance, maintains stable dividends. AHP stock price much higher but financial quality shows that sometimes paying more is better than get more. The third pair gives us to the world of retail. S and Montgomery World. 2 commercial empires were once American consumer icons, same industry, same model, same long history. Steam. But when looking at the financial structure, main, operational efficiency and strategy extend. SES shows clear superiority obvious. They invest in logistics early, management better inventory management and exceptional retention. Be financially disciplined even when growing fast. Meanwhile, Monomar Rush join the race to capture market share by expansion. Haste leads to big costs, efficiency declining yields and volatile profits. Strong. The market was not clearly priced at that time. Clear this difference. But after a few years, C's stock increased by 1.5 times, and Mary Watch off-road. The lesson here is very obviously, the two businesses have the same appearance. But if one side is cautious and the other waste, the outcome will be different. Abyss. The fourth pair is Dow Chemical and Ali Chemica, two companies operating in chemical industry with global coverage, same size but due to the production strategy clear products, focus on product groups high-margin products and value chain closed-loop management. They accept growth slow but safe. Alice then pursued multi-industry and as a result operating costs complex, unstable profits. One again, Ali's PE is lower. But cheap does not mean attractive if the border is safe all worn out. Next is the second pair. Years and American Motos. This is a comparison. It's not easy to compare because both work in the auto industry which is very cyclical and volatile. Strong movement at the time of analysis. Chrysler had just recovered from a period of difficult while American Motors is being hailed as a rising star. But when looking closer at the balance sheet accounting, cash reserves and schedules history of overcoming crisis, Chrysler's sustainability more clearly. And it was true, after a few years when the economy slowed down, Chrysler Ericon Motors stood firm while Ericon Motors staggered. The lesson here is that when the industry is cyclical, choose a business that has staying power. Are not the hot business is Pacific Gas and Electric and Detroit Edition, two energy companies in the same field, same business model but PG&E work operating in a fast-growing state, with policies to support businesses and population continuously increasing, creating a foundation for business long-term income. Meanwhile, Detroit Edison operating in industrialized regions reduction, under great cost pressure and demand electricity gradually decreased. Stock prices do not reflect this difference fully. Once again, investors with eyes and vision long-term will have clear advantages. Lessons learned. This is the geographical location. Main environment books and population trends can be beneficial. Invisible but extremely important in business valuation. The seventh pair. I want you to pay close attention that in the middle of a job a company with a high dividend yield and a reinvest all profits. Market usually like dividend stocks but if you analyze carefully you will see the company retain profits for reinvestment. Efficiency usually accumulates value better in the long term provided they have a plan clear and competent capital usage plan deployment. And the last pair I saved for something interesting. A company has strong brand and a company that does not name but good management. Mostly investors choose brand companies, but smart investors will look at profit margin, debt ratio, operating costs, conduct and level of transparency. For the brand irreplaceable for intrinsic value. Especially if the brand has to borrow money to keep the good light. 8 pairs, 8 lessons. But if you look deeper, you will see a common denominator. Price is what you pay, value is what you get. Dual market when pricing is wrong, but you can't incorrect valuation. Always remember that so comparison is not just about choosing the better one. Is to understand why the better mispriced for the greatest reward in investing does not come from how good you are. Guess that comes from you're good at comparing and patient enough to wait for the correction inevitable of the market. Now imagine you are a shareholder of a company. Listed company. You bought the stock, you own it. Own part of the business but you really have a say, you get to participate involved in major decisions. You get protection from unscrupulous behavior. White paper of the board of directors. Many investors individuals do not think about those questions. They buy stocks like they buy betting tickets. Not realizing he was becoming one part of the decision-making machine. Business and the most dangerous thing, if you don't ask questions, someone else will act for you. Here I tell no, it's not about stocks, it's about power and responsibilities between owners and operator. I have witnessed countless the case of the board of directors of companies. The public views businesses as assets separately, spending shareholder money on those unnecessary business, overpaying level for yourself or hide information adverse news, and the sad thing is that the crowd was almost silent. In some companies, the shareholders meeting is just a formality. The person in charge has total control. PRVOS decision-making body, and all proposals were passed without no objection. Many shareholders do not sad to read annual report, not come meeting, and no questions asked. As if their money has been entrusted to someone completely different. I think this is an extremely dangerous anti-investment culture. Dangerous because if shareholders do not play a role, if they are supervised, who will protect them from arbitrariness? Management facilities. One of the most common problem I see is that management reinvests profits accordingly, ineffective or worse, for the benefit of shareholders. They expanded to non-specialized field, implementation, indiscriminate mergers or cash retention instead of paying dividends just to maintain rights control. You must understand the retained earnings remaining in the company is the property of the shareholders. Winter. If the management cannot use that amount of money to generate excess profit superior, they should return to shareholders, through dividends or stock buybacks. Any other behavior is questionable. I once analyzed a public company. Profitable business for many years but no dividend increase. They kept close like all the profits and use it to invest in real estate. After 3 years. Those investments suffered heavy losses, stocks the company halved, and when shareholders place question, the leadership replied, I believe this is a long-term strategic direction. Limited, but what strategy to counteract? The investor himself. That's why I always encourage shareholders to be more proactive. Read the financial statements, ask about them. Big deals question when profitable profits not converted into stock value. Winter. Because if you don't ask, you're keeping quiet. Silently signed a blank check. Remember the crowd is not just the one who gives money, the shareholders most are owners. In fact, the company has a transparent management system. And good. Where management treats shareholders as companion, not bearer battle. These companies often pay dividends. Regular, transparent, and public information. Clear information, no hidden holes. Board of directors have actual shares in the company, not salary only. I particularly believe that good managers are those who behave like themselves as minority shareholders. Surname. Be careful, save and always ask questions. Question, does every dollar spent help increase prices? Value for investors. I used to meet a CEO who only accepts salary, moderate salary, keep most of the assets in company stock and never now spend too much money on brands. Show off, shareholders love. He does it not because he promised but because he did it, and keep your word. If you are a shareholder, please learn from investors like John Bogle. It has been said that shareholder power is not to argue but to force the leadership to remember who is the real owner. Please ask the administrator well, argue when necessary and get out. If you see management abusing rights, because in investing you don't just buy stocks, you are placing your trust in decision makers. Don't let your faith that news is exploited by indifference. And I want to mention 3 words: safety margin. All smart investors from classic to modern, from value to growth. If you really understand the nature of investing, back to the same principle. No investment if there is no safety margin. And if you still thinking margin of safety is a concept, dry concepts only for accountants, or if you are an engineer, let me tell you a story. Story: a bridge with maximum load is 10 tons. You drive a 9.8-ton truck. Come near it. It's raining, car tires slip. Did you drive by? Answer: word. If you have any sense, no. You do not test the limits of the bridge. You don't bet your life just for the sake of having one. Looks fine, you need a safety margin. Invest same, you don't buy stocks because it may increase, you don't put money in company just because it seems stable. You must requires a large enough difference between real value and the price you pay. If no, you are not investing. Your bet safety margin is a buffer, is the protected area, the extra space that you hold back so mistakes don't kill you. Because in investing, mistakes are certain. Sure, only safety margin will help you survive. I have seen investors, even the smartest, make mistakes. They intend to wrong price of future profits, they evaluate low industry risk, they put too much trust in large on the board of directors. But what keeps them not destroyed, is the margin of safety has been built before. Imagine you value a company at its true value around $100 per share. If the market is trading at $90, should I buy it? I don't. I just buy when price is at 70 or below, because the $100 figure is an estimate, not an estimate. Must be true. It is based on assumptions, and every assumption has its flaws. You cannot completely avoid mistakes. But you can reduce its consequences by requiring a sufficient price gap safe. In construction, people design bridge designed to withstand 23 times the load maximum expected in aviation. Engineer aircraft wing design with safety factor superior, and margin of safety investment is the gap between the actual value and the expected value you give up. But I know someone will. If so, then I will not buy anything. Modern market is not easy to have stocks such a deep drop. And I say, if not, if you have the opportunity, do not invest. Wait, be patient, keep cash. Because of the market, school always has moments of panic, always has, when the valuation is wrong. And only then people patience pays off. Safety margin, it's not just a number, it's an attitude living. Is humility before the market, is words admit that I could be wrong and I want to still stand firm even when I'm wrong. Have periods like the late 1990s, 1960s, when the market is so excited that everyone's stocks are all traded at prices higher than real value. At that time investment price treatment was considered outdated, but then everything reversal and investors without safety margin lost. I don't promise you will always win if you use this principle. I'm only sure of one thing. You will not lose miserably. And in a world where heavy losses are common, what cannot be reversed is avoided. That was a victory. See the border, all core principles like the heart in the body. Invest, lose it. Everything else are meaningless, because investing is not choosing right, is not the art but the science of reducing it. Minimize errors. And the safety margin is the most powerful tool for that. When we go to the end of a book like that Intelligent Investor, the takeaway not simply concepts like PE, margin of safety, or dividend, which is an attitude towards life, alert, cautious but resilient to change the end of the financial world and of life living. This book does not teach you how to get rich quick. It also does not hold hands like a digital age money-making guide. Opposite, it sharpens thinking and awakens independence. And help you build a foundation yourself, without which market can evaporate in a moment. Trading session. Thank you for your time. Listen and choose this journey with me in a world where concentration increasingly rare, full presence. Your integrity is what I treasure. Each the lines you listen to, each paragraph you stop and think are all evidence of investment. After all, it's not just about money. But it is a way you deal with risk, uncertainty, and oneself. If you see something about this book touched me, even just an idea, a good method, any questions, please leave a comment. Must let me be grateful, but let the community, people who seek intelligence together in investing. There is an additional support from your own experience. Sometimes a true feeling is more powerful than a book chapter, and if you have a book, something that made you see the world differently, go or ever make you reset the whole assumptions about lifestyle, spending money, or how to keep assets, please suggest me. I don't promise to tell it perfectly, but I promise to read it with all my heart. Respect and curiosity of a person who has loss, mistakes, and understanding that every financial decision must be start from an inner choice. Appointment. See you in the next book.